Cryptocurrencies Investment Guide. Things you should know before investing. Choosing an exchange. Binance, Coinbase, Huobi, Kraken, Crypto.com, FTX, and Gemini are some of the biggest names in the market, each offering different products and allowing withdrawals to different sets of blockchains. Sign up and verify. An investor will need to verify their identity. After the verification is complete, investors can buy, store, or transfer their crypto assets outside of the exchange. Store in a wallet. We have hot wallet and cold wallet. MetaMask, Kepler, Phantom Margin, XXDeFi, and other browser wallets are considered hot wallets because they are connected to the internet. Investors who plan to hold significant amounts on the chain or favor security over ease of use are better off using cold wallets like Ledger and Trezor. How to research the right way. Performance metrics. Distribution of the holders and market cap are some of the metrics to be monitored when considering investing in a blockchain. Promise delivery. There are countless examples of blockchains, NFT projects, DeFi apps, or decentralized infrastructure boosting the expectations with undeserved hype not delivering on time, and leaving investors with mass disillusionment. Avoid these 5 biases. Unit bias. When investors make assessments on whether an asset is expensive or cheap based on the unit price rather than its market cap, they fall into the unit bias. Investors should know that they can always own a fraction of these assets. Sunk cost fallacy, also known as bagholding. Sunk cost fallacy is when an investor with an invalidated thesis doesn't want to part with their holdings because there is too much time spent holding the asset or the asset already losing its value, giving the impression that the downside is limited. Survivorship bias, focusing on the winners and neglecting the silent majority or the losers may make an investor miscalculate risks and overestimate their probability of success. Endowment effect. When an investor gets emotionally attached to their holdings, which is quite prevalent in crypto with the presence of a community making an asset a part of their social identity, they start filtering out negative parts and overestimate the positive ones, resulting in irrational decision-making and attachment. Hindsight bias. It happens when an investor retroactively assigns greater predictability to an event after its occurrence.